Okay, let's get started. Good morning and welcome to today's Tuesday Markets Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, kicking off with the major equity indices, highlighting some key levels where we have seen a broad-based decline over the last few weeks, but price is approaching some support levels, so we will be taking a look at that as a potential point of reversal. From there, moving on to fixed income and commodities, we'll also take a look at the sector rotational model, seeing some interesting rotation as of late. We'll take a look at a subsector of interest that I have for you today, and as usual, ending today's webinar with some bullish and bearish market observations. So SPY, so we're looking at the S&P 500 here, and we have seen this broad-based decline, which was really triggered by this by the Fed meeting that happened a couple of weeks ago. We saw prices essentially consolidating ahead of the Fed meeting below the 455, 450 area of resistance, but also forming higher highs on the daily time frame. But the Fed meeting turned out to be a bearish catalyst, and we saw a breakdown below this 435, 430 level as well. Now, a big reason for that was due to the fact that the Fed is a bit more hawkish than originally anticipated. Inflation is still somewhat concerning for the Fed, even though it's at a much better place than it was, let's say, a year ago. However, markets were pricing in a much more dovish Fed during the summer rally. And what I mean by that was there were even talks for potential interest rate cuts before the end of the year, combined with 4 interest rate cuts that were anticipated for 2024. However, that's actually, with inflation not really coming down as much as expected, the Fed have actually stated that there will be another interest rate hike, most likely, probably in the next meeting or definitely before the year. We still have 2 more meetings until the end of the year. And not only that, but right now, markets are only pricing in two interest rate cuts for 2024 as opposed to 4. So that is why we have seen this unwinding lower for the S&P 500, breaking below 435, 430, consolidating a little bit this week, but still opening lower this morning. So the bearish bias remains. And we also have another big event, non-farm payrolls, this Friday. And this is going to be quite interesting because given the fact that the Fed meeting was 2 weeks ago, this NFP number will be closely watched. The reason for that is if NFP comes out higher than expected, meaning there's more jobs, usually in normal economic conditions, that's a positive, right? More jobs equals a stronger economy. However, given the fact that labor inflation has been a key contributor to overall inflation, and it's a big concern for the Fed, if we do get a higher NFP number than anticipated, what would happen is we'll see most likely a bearish catalyst for equities and a further decline. So right now, usually what happens a few days before this NFP report is some consolidation, which we are getting this week so far. But again, that does have the power to be a catalyst. We could see price continue to decline closer towards this 420 level, which is also the 23.6 fib level before we see a potential reversal. But I think that, this NFP report is going to be quite a big mover and could either act as a downside catalyst and a break below 420 towards 410, or it could act as a reversal point for, some capitulation, maybe more neutral price action before we see a slight bounce up higher. Now, the other thing to be looking at is, of course, with consumer spending, that has been a huge part into the summer rally. We saw consumer spending was still relatively high, despite the fact that interest rates were high, and that provided a very nice sweet spot in a way that we could combat inflation while also keeping consumer spending quite high. However, we know now that the COVID relief from student loans, student loan repayments, I should say, that ended on the 1st of October. So that is going to impact 44 million Americans, I believe. And that will also have a negative impact on consumer spending. And that is something that we do need to be made aware of. Because given the fact that consumer spending has been quite strong, we may see lower consumer spending, and that could also fuel room for a further decline. On the positive side of things, government shutdown has been avoided. They have come back with an emergency package. So we do think that the fact that the government shutdown has been avoided, we will get more economic data because of that, due to the fact that during a government shutdown, there is a lack of economic data. And with more economic data means it's more bullish catalyst to the upside. So that is some good news. It's not necessarily a bullish catalyst in itself, but it does give the option for more economic data, which could eventually see markets turn around. But for now, S&P looking quite bearish. And we have 420 and not to mention 410 as the two levels of support that we are looking at. Okay, the Qs, looking at the NASDAQ 100. Performing a little bit better than the S&P, maintaining above this 352 support level, but still above its 21-day and 55-day exponential moving averages. Now, I would still say neutral to bearish bias here for the NASDAQ 100, and usually, the NASDAQ and the S&P do move with a high correlation. But what you do want to measure is whether the NASDAQ is outperforming or underperforming the S&P. And in this case, it is outperforming. It's managing to stay elevated when the S&P is declining in with a bit more pace to the downside. Price is set to open a little bit lower this morning. So even though this 350 to 350 area is acting as support, it's not exactly a huge point of reversal. It does seem that price is respecting the support level, but not moving that much higher. So the NASDAQ 100, not really too much to say other than that, because it is maintaining above support, but it's going to be moving in line with the S&P as well. So there is still further room to the downside. The next key level of support, should 350 break, is at 340. So not too far for the next level of support for the NASDAQ. Okay, IWM, the Russell 2000. Big breakdown, and of course, we are seeing that usual underperformance relative to large caps. So IWM is a small cap Russell 2000 ETF, and we have seen a breakdown below 180. This was a previous area of resistance, turning into support between 182 and 180. But again, the Fed meeting was the bearish catalyst to see price break down, retest, and continue lower, with a lot of bearish momentum here behind this move, set to open lower this morning, and it does look like price is heading towards that 170 level, which is definitely going to be a major level of support, given the fact that not only has it acted as a major level of support on the daily and weekly, but also the fact that it's a 50% fib level. So keep an eye on what happens with price at 170. If we see bullish price action there, it may provide a bit of a better risk to reward bullish entry point targeting 180. But for now, small caps underperforming large caps still means that you'd much rather, if you are going for a bullish play, you'd still want to look at the large cap indices like the S&P and the NASDAQ as opposed to small caps. So TLT, and I have to zoom out quite a bit here. I have to zoom out quite a bit here for TLT, because we are looking at levels that haven't been reached since really more than 15 years ago. Big breakdown below that 88 level of major support, as you can see on the weekly time frame. This was achieved between 2009 and 2012, and we saw price kind of get to that level, initially finding some support at 88, but then immediately invalidating that and set to open lower this morning. So TLT very bearish, but also at an oversold condition, now approaching that oversold condition with this bearish price action. I do think there's further room for decline, given the significance of this 88 major support break. Next major level is at 82, and there's a lot of bearish momentum behind this move. So I do expect price to potentially reach that 82 level. But yeah, TLT quite bearish, a little bit oversold, so maybe wait for a retracement higher. I've said that for the last few weeks, but we haven't actually quite had that retracement higher. Those retracements have been very limited. So the risk to reward for bearish entry point is quite tricky. I'd like to see something of a rally towards a 21-day exponential moving average before looking for a bearish entry point. But given the bearish momentum that we are seeing, that may not even happen. So TLT, as much as it favors the downside, you'd have to wait for good entry points, in my opinion. So US dollar, looking at the DXY symbol, and the US dollar is incredibly strong right now. So much momentum behind this move, and it's maintaining this very strong bullish momentum, breaking above 105.50, coming back to retest it quite recently. Perfect retest and bounce, and continuing higher. So the dollar index showing a lot of strength, approaching the next key area at around, let's say, 108 really would be the next key level. As you can see in the weekly time frame, that was the next level that had provided some support and resistance. But yeah, underlying momentum is strong. Price should be able to reach that level quite soon. And this is obviously due to the fact that the Fed is a lot more hawkish, which supports a stronger dollar. So we are seeing a bigger move to the upside. And of course, with the stronger dollar comes a weak gold reading. So gold has now approached a heavily oversold condition, 50-period CCI below minus 200. So I do expect to see a reversal quite soon, even if it's a retracement higher. But the key thing to note is that price has broken below 175, major support level. And ever since it broke below 175, we have seen significant downside momentum here. So I do expect to see maybe a retest of this level or a bit of a retracement higher, but that should provide another good risk-reward bearish entry point towards 167. And as long as the dollar remains strong, what you're going to be looking for, what you want to look for, are short-term rallies in gold to provide good risk-reward bearish entry points, because gold does move inversely to the US dollar. Next key level to be looking at is really, of course, 167 to 165. And from there, it's quite difficult to find an exact support zone, but 158 to 160 would be the next key area below that. So there's some significant downside ahead of gold breaks below 167. And oil. So oil, we are finally seeing some bearish price action, and this has now happened at a resistance zone at 93. Major level of resistance, 93.94 on the weekly time frame. And if you look on the daily time frame, after price reached the 94 level, it has been quite bearish. There's some minor support at around 88.50. But price is breaking below that as of today, breaking below its 21-day exponential moving average. And the spread between the 21 and 55-day exponential moving average is quite large, indicating that this rally is a little bit overextended. So we could see potential for a further decline here, maybe towards that 83 level for retest, and from there a bounce to retest the 94 level. So bearish price action in the short term, but supply cuts are going to act as a natural headwind for oil. As a natural tailwind for oil moving forward. So that's the short-term reading. I do think the technicals are pointing towards a more bearish play, but the fundamentals still support, and the macro perspective still supports oil strength and oil to continue higher, or at least stay at these elevated prices. So the sector rotational charts, and we have a good bit of rotation here, actually. 7 sectors now in the improving and leading categories, and 4 in the lagging and weakening. So energy still continuing to show good signs of leadership. However, this is a weekly time frame, so there's a bit of a lagging component. And energy, with oil prices declining now, we could see it start to weaken from this leading category. In the weakening category, we have technology finding some momentum here. It is still heading towards the lagging category, but finding some momentum actually as it's moving higher. Same with communications, has been moving higher over the last few weeks, indicating good relative momentum against the broader markets. And we have discretionary, not really finding as much momentum and rotating towards the lagging category. Another leading category that I almost forgot about was actually financials. It is now in the leading category, losing out a little bit on the momentum side, but still performing quite well against the broader markets, given the broad-based decline. Utilities back in the lagging category, but staples still maintaining in the improving category for now. Real estate on its way to the lagging category, and so is industrials. Healthcare still staying in the improving category for now as well. So our defensive sectors, not a lot of momentum behind them, but still, outperforming other sectors, especially the ones in the weakening category. So moving on to subsectors of interest, and just the one for you today, which is a name that we have been looking at for quite some time, maybe for the last 2 weeks or so, and that is TAN, the solar ETF. We were looking at this name when price was at around that 56, 55 level, and our target price was at around 49. That target price has now been hit to the downside. And if this was a trade that you did take, I think now is a great time to be taking profits on this name. Worked out quite well for us. It's overwhelming a bearish pressure, but this decline does seem to be a little bit overextended, and it is at a major level of support. So this does provide a good exit opportunity for a healthy profit as well. Moving on to our market observations, we have JP Morgan, another bullish play from the last couple of weeks, and we were bullish at around 144, 145 a couple of weeks ago, given the fact that price had this huge breakout above 144, 143 resistance, coming back to retest nicely and was showing bullish price action at the right place. But it hasn't quite been able to break above 150. Price is back at this level, and I would say if price closes below this red line at 144, if we see a close below that today, that would invalidate this trade, and we'd have to close it for a loss, unfortunately. Even though JP Morgan is the best performing major bank relative to its peers, is still performing very well against the broader markets, but it's still not immune to the systemic risk, and we are seeing systemic risk be quite high, and a broad-based decline is also impacting JP Morgan here. So look, it was a good risk to reward, but let's see if price closes below 144, that would indicate closing out this position today or tomorrow. So Qualcomm was a bearish play on the semiconductor space. We were bearish at price being near 113. It did move lower initially, coming back a little bit higher, but still struggling to close above its 21-day exponential moving average, set to open lower this morning. So this opens the door for a further decline. Target price at 102.50. So kind of a short-term entry point, not expecting a huge decline here, given the fact that on the weekly time frame, we can see price is at this major support level, but on the daily time frame, it's definitely under pressure from its exponential moving averages, and again, providing another good risk to reward bearish entry point for the move back down to 102.50. So Dexcom is a new idea for today. It's a bearish play, and what we saw with Dexcom was, initially a strong move to the downside, followed by this retracement higher back towards its 21-day exponential moving average. Now, bearish price action there indicates that this retracement might be over. And also, the overwhelmingly bearish trend, in my opinion, has not been completed. Price is still approaching that $70 to $80 level of support, and there's still more room to the downside for this trend. So given the fact that we've had a retracement quite recently, it provides a good risk to reward bearish entry point. Just keep in mind earnings just at the end of the month. That's the only thing you want to be looking out for. But I do think it opens the door here for a continuation lower, targeting that $80 level. IBM has been a bearish play for the last couple of weeks now, ever since price was rejecting that 150 level. We entered at around 148. And this is a major level of resistance. If I zoomed out further back, this price has essentially been in a trading range between 115 and 150 for the last 2 to 3 years. And now, with price reaching that level quite recently, it provided an excellent long-term risk to reward bearish opportunity. So far, it's working out quite nicely for us. It is at a minor level of support at 140. I think there's more room to the downside towards 137. That will be our target price. From there, you'd want to look for a retracement higher, and then look for another bearish entry point, maybe after the earnings announcement, again in October. So because IBM has a long-term bearish outlook to around, let's say, this 120 zone, I don't think it makes sense to have one trade to gain this bearish exposure. I think it makes more sense to play on the micro trends during the overall bearish trend. So because we're at a closer take profit zone, wait for a retracement higher, then play the move lower, wait for a retracement higher, play the move lower, and eventually price will reach that 122 level, hopefully. But that is our major downside target, but this could be broken into multiple bearish trades. Whirlpool is a new idea. It's a longer term idea, and it's not really one that I would execute on right away. It's more to add to the watch list. I'm looking at 132. What am I saying? The 125 area of support. This level basically on the weekly time frame. We can see price is on a bearish trend, no doubt about that, but it is approaching this major support level that has held up quite nicely, even since last year. And once it reaches that level, it does provide a good risk reward, longer term a bullish opportunity, whether you want to buy the shares outright or you're looking to, look into options to gain that bullish exposure. Either way, once price reaches at 125 level, it provides a good risk reward. And you'll be targeting that 160 area, which is the major area of resistance on the weekly time frame. So with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week, Tuesday, for another market outlook. Thank you, everyone.